So what do you need to offer to private investors to get them comfortable coming in and partnering with you on your property deals? What is the return you offer them? How much you offer them? How is that return structured? It's a really important question because you really need this knowledge in order to be able to actually properly position and present an opportunity to a potential investor. And the answer to the question is really that it depends, and primarily depends on two main things. One, it depends on the particular deal, and the deal is made up of both the project and you. And then the second thing it depends on is a more wider macroeconomic factor, which is where I want to start. And so in kind of macroeconomics, you have this concept called the risk-free rate. And the risk-free rate in economics is essentially the return that an investor can get on their money if they take no real risk. And really, that is defined by what government bonds are willing to offer. And so government bonds is where essentially the government is borrowing money and they are offering an interest rate on that money they borrow on that particular bond. And the reason government bonds are risk-free is because technically the country shouldn't be going bankrupt. If they get anywhere close to bankruptcy, of course, they can just print more money. And so really government bonds are considered to be risk-free. And so what you have to think about is if an investor can go to the UK Treasury and get a bond which pays them a 5% return, well, that is the kind of minimum hurdle that they can get without taking on any risk. And so when they're looking at other investment opportunities outside of those government bonds, essentially what they're looking for is what returns can they get over and above that, and also what is the premium between the risk-free rate and that return that's being offered. So to give you a very simple example, if I was to go to an investor and say, hey, Mr. Investor, would you like to invest in my real estate project? There's a number of risks. There's the construction risk, the exit risk, the planning permission risk, and I'm willing to offer you 5% on your money. Well, that investor, if they're somewhat sophisticated, they've got a decision to make. Do I invest in government bonds and get 5%? Or do I invest in Tyler's project, which still might be a solid project, but there are some risks, and only get 5%? The answer is probably doesn't make sense to come and invest in my project. And so what we have to figure out is what is the premium that I have to offer to an investor above that risk-free rate in order for it to make sense. And of course, as markets evolve and the risk-free rate that government bonds are offering goes up and down, well, that's also going to change what banks and what investors are willing to expect as a return on their money. And so really, when we're trying to factor in what is that premium, ultimately investors, they're making a decision on risk and return. Are they getting what again is called in finance and economics as risk-adjusted returns? So adjusted for the risk that they're taking on. So factoring for that risk that they're taking, are they getting a return that makes sense? Let me give you another example. If I was to say to you, I've got an opportunity where I can potentially double your money overnight. If you give me £10,000, I could potentially double it overnight with this opportunity that I've got. That might sound like a good investment because it's a very solid return in a very short time frame. But if I then told you my strategy for doing that is I'm going to go to the casino and put your £10,000 on red, where there is a chance I could double the money, but as we know, where the house always wins, actually in that particular strategy the odds are in favor of the house and I could potentially lose the money, well then adjusted for the risk that I'm taking, even though I'm doubling your money, it's not a good return, or it's not a good investment opportunity. And so really when you're making an offer to investors on the return that you can offer them, you're pricing the risk. You're essentially trying to figure out what is the risk of this project, what is the other opportunities that are available to this investor, what return is going to make sense to them. And so the second part of this, coming back to my first point, risk also comes down to the particular project. And the particular project is made up, of course, yes, the project and the risks associated with the project, but there's also risk associated with you as the operator. And so a very experienced and sophisticated operator could probably get money at a bit cheaper because the perceived risk from investors and banks is going to be lower. If maybe you're a first-time operator, first time doing a deal, it's your first time raising money for a project, well then the perceived risk might be a little bit higher, and therefore you might need to be a bit more generous with what you offer to investors. So who you are and also the team that you've assembled is a big thing, because actually when an investor is making an investment decision, they're investing in the deal, they're investing in you, but also they're investing in your team. So building a solid professional team that do have years and years worth of experience and plenty of kind of transactions and deals under their belt is going to decrease that perceived risk and therefore get the investor more comfortable with investing with you. But then also there's the risk of the particular deal. What is the construction risk? What is the planning risk? What is the exit risk? What is the operational risk, et cetera, et cetera? What is the financing risk with the banks? And then the really final key part, and this is one of the bigger factors, is what is the structure of the financing? And this is something you really need to understand again if you're raising finance from investors. Is the investor loaning you money as a loan, or are they coming in as an equity partner? If they're an equity partner, well, where do they sit in the capital stack exactly? What other layers of capital make up the capital stack, which is a term used to define the different layers of capital that make up the ownership or the acquisition of an asset, in this case, a property. So are they debt? Are they equity? If they are debt, what level of security do they have? Do they have first charge where they're senior debt? Are they a mezzanine loan where they're coming in on a second charge? And what is the loan to value of those other stakeholders? How strong is the security? Is there a personal guarantee that's going to be signed? And so all of these things basically that I've shared with you are factors that make up the risk of an investor loaning you money, because if they come in as an equity partner, that's going to be higher risk when if they're a joint venture partner than if they are loaning money on a first charge with a low loan to value where they have more security. If they're an equity partner as a joint venture, well then the return is going to be more of a profit share than an interest rate. If they're coming in as a lender, well then their return is going to be an interest rate that's fixed. It might not be guaranteed, but it's fixed, and therefore that certainty means they're happy to take a reduced return over maybe taking more risk as a joint venture partner. So these are all things that you need to understand. These are all the factors that essentially make up how you calculate and figure out what makes sense for a potential investor. If you want help raising finance, myself and my team, we have a consulting program where we can help you raise your first £100,000 from private investors for your next property deal, which could generate £30,000 to £50,000 profit. And we'll work with you to do this in the next 120 days. We'll continue to work with you for free until you do. If you like the sound of that, the first link in the description will take you to a short demo where we'll walk you through the consulting program, Property Blueprint. And if you like the sound of it, please book in a call. We'd love to chat with you and help you on this journey. I'll see you guys soon.